I'm Bill Duryea, and today is May 26, 2013. We'll begin today's discussion by taking a longer-term view of the recent development in the S&P 500 E-mini. On May 14th, the S&P broke out above its previous high, and that was the starting point of the rally that ultimately terminated last week with the S&P auctioning up to 1685. The market structure tells us where the buying interest and selling pressure developed in the market, and it also indicates the state of the market during a particular time period. So beginning with May 14th, we had a transition from a consolidation state into a rally, and that rally lasted for 2 days with the S&P trading up to 1659 before the market made its first initial pullback. The pullback corresponded with the low on the 15th and the bottom of the cluster that developed during the initial rally phase. The market then auctioned back to the high and paused below the high, but then continued and extended the range up to 1666 before pulling back and retesting the prior high. There was a period of approximately 2 days of consolidation. During each day, you can see the market managed to make slightly higher highs, but the bulk of the trade activity was contained within the parameters of the 2-day consolidation range. Then on May 21st, the market broke out above the prior high and added to the range significantly. It auctioned up from 1670, the approximate prior high, and traded up to 1685. And that now stands as the new multi-year high. Following the move to the new high, on the pullback back down to 1670, there were more sellers than buyers in this upper cluster. In other words, the large dominant financial institutions sold into the rally. That went on for the majority of the day. The market spent a good 3 or more hours trading at the high. And then finally, when it pulled back again to the prior high at or near 1673, 1672, the selling pressure accelerated and the market auctioned down through the prior 2.5-day consolidation range and sold off down through the prior low, the 3-day low, and traded back to the pullback target, almost trading down to the initial pullback target down at 1646. This is referred to as a rout of the trading range. Technically, it is a fat tail distribution. The selling pressure that occurred on the FOMC session was followed by a retracement back up at or near 1660, 1659, and then in the overnight session, the selling continued and the market pulled all the way back initially to the starting point of the May 14th rally, trading down to 1632. The S&P held support there on the initial pullback, and price rallied back up at or near the prior resistance level at 1659. It paused up at 1653, 1654, and then on the following day, auctioned back down and retested support down at the 1632 low. Another chart that I find helpful in viewing the market structure is the point and figure chart. The parameters are obviously identical, but what I like about it, it includes the zigzag indicator, And so it gives you a good idea as to the ranges associated with each of the major moves. So coming up off of the low during the breakout, from the low made back on the 12th down at or near 1620, the market rallied up 38 points. The initial pullback was 11 points. The retest of the high was 10 points, followed by a 12-point pullback. Following the 12, 13-point pullback at or near where the market had paused the day before, the next rally leg took the S&P up 24 points, and that 24-point run was followed by two pullbacks, approximately 10 points each, before the market made its final move 21 points up off the median of the two-day cluster to trade up to the exhaustion point up at 1685. This area is of significance because, number one, the market had not previously traded there, so no trade had occurred there the day before. And as I mentioned earlier, if you were looking at the order flow monitor during the development at the high, each retracement during the development of the high was accompanied by high-frequency sell surges. So this is why we deem this to be the supply cluster. And that high-frequency selling continued as the market traded down to the 1660 price level. In other words, longs in the previous two-day consolidation cluster liquidated positions there as well, and the only indication of buying interest occurred when the S&P pulled down to the previous three-day low down at or near 1642. As I mentioned, that low was breached during the overnight session, and then we had good solid buying interest down at the 1630, 1632, 1634 price area. Going back to the idea of classification and pattern recognition, it's very helpful to ask yourself a series of questions regarding your visual observation. So, for example, what is the dominant direction of the market during this phase, these past 2 days? Is the market trading vertically or is the market trading horizontally? So that's the first question that you want to ask yourself. And then when you feel you have answered the question sufficiently, that you say, okay, I can look at this now and I can see that indeed the market is trading horizontally, there's a pattern of consolidation developing, then you can go back and ask yourself, during this phase when the market consolidates, what are the trading opportunities? And then you describe to yourself the trading opportunities. So for example, we knew that the 1632 was the breakout point, the starting point of the last rally, and therefore, since the prior distribution contains all we know about the previous market development, and so we knew from 1630, 1632 that the S&P rallied up to 1685, we can then draw an inference whether or not we think it would be a good trading strategy to buy the pullback. Now, if you don't know whether or not that would be a good trading strategy, no harm there. We all start at some point. You can follow the same line of reasoning, however, and annotate, as I've done here on the chart, whatever your thoughts are. So let's say that you didn't think it was a good idea to buy the pullback, that you thought it would go lower. Then you would write out your notes. This is kind of a form of a trading log. that I think it was going to go lower. I thought it would sell down to wherever you thought it would sell down to. Now you see what the factual outcome is, and in this way you then modify your thinking according to what has developed. Now after it traded down the first day to the low, it auctioned back up. As we mentioned, we had 1658 as that prior resistance level, so it auctioned back up to the prior day high. Was there a reasonable expectation that the market would stall there, and would that offer a potential short opportunity? So then you come over and you describe that trading opportunity to yourself, and then you note the outcome of it. Now, when the market pulled back the second time to retest the low, in your best judgment, was it an opportunity to buy the low again? If you thought yes, then you note that your inference was correct and the market rallied back to the prior high. If you thought it wasn't a good idea, then you explained why you didn't think it was a good idea. This is a very practical way to accelerate the learning curve and to achieve your optimum performance sooner than later. Now, if you bought the low and you saw the market rally the day before back up to 1650, 52, and you were trying to make an assessment, if I get long here at 32, what should the trade be worth? Well, this is how you would then determine the estimated value of that position. Now, if you took 1 point, well, you can see here there were several opportunities to just scale in and out and to scalp a few points, but ultimately the trade paid off handsomely. So you can explore different strategies of trading. You could scalp it and see what that's like, see if you're happy with that immediate quick return, or if you think that you would be better served by holding the trade, then you can experiment and explore what that's like. And in this way, you will ultimately find your niche, that approach to the market that suits you. And finally, on this last chart, I've indicated a series of red and blue arrows. Now, at the resistance levels, the red arrows indicate the most likely expectation, and the blue arrows indicate the least likely expectation. And at the support levels, the blue arrow indicates the most likely, and the red indicates the least likely. So by marking my chart up in this manner, if I do this consistently, I have now prepared myself for what might occur in the future. If the market trades back up here where the red arrows are, my initial thinking is that potentially the market will encounter resistance. So now I can then determine in my best judgment if I want to be a seller on this retracement. I can also begin to think, if I sell this retracement and the market is to continue higher, at what point in the continuation will I recognize that my inference is not correct and that it is no longer likely for the market to pull back, and it is more likely that the market will continue up to the next resistance level? In this way, I am prepared to adapt my strategy. I can determine where I no longer want to defend my short position and where I might want to buy the pullback with the expectation that the market will continue up to the next resistance level. Similarly, here at the low, I see now where the market has held support, where I want to be long on the pullback, and I can now determine, should price trade below support, where should I exit the long trade and think about selling the retracement?